In this section, we will look at patterns. These are two or more candles in succession that can typically indicate a certain future movement. Keep note that after each explanation from here, we will show these patterns and indicators on a live chart if you have already purchased a package. We start off patterns with the Heikin Ashi. We do this because it's a fairly simple indicator to use and to understand. This pattern is similar to normal candlesticks, but the difference is that the Heikin Ashi calculate the average price over the last two periods and smooth out the chart. Ideally, traders like using it for longer-term swing trading. This is because the Heikin Ashi chart shows the average and not the actual price. For long-term traders, this is not a problem, but for intraday traders, they may look more directly at current price. In this chart, you can see a comparison between the Heikin Ashi and a normal candlestick pattern. The Heikin Ashi gives a smoother and easier to read look compared to the candlestick on the right. A Bullish Harami is a basic two-candlestick chart pattern. This indicates a bearish trend in an asset or market that may be reversing. The Harami means pregnant in Japanese. You can see that the long red candle gives birth to the green candle in this photo. In this chart, you can see the bullish trend occur after the Bullish Harami pattern. There is one candlestick that tests the support line before the huge breakout. Oftentimes, when you see the Bullish Harami pattern, pay attention to the following trend, and we will train you on where to put stop losses and take profits in order to enter the trade correctly. Here we will discuss the Bearish Harami, the exact opposite of the Bullish Harami. Following an upward trend, if a trader notices a Bearish Harami, that is, the green candle giving birth to the red candle, this is a good sign of a possible trend reversal. In this chart, we see the start of a bullish rally. At the very peak, we notice that there is a Bearish Harami pattern and ensuing downturn afterwards. One note to keep in mind is that at the top of this pattern, we see the Bearish Harami, which is already a good indicator. After we see the Bearish Harami, we notice that the candlestick afterwards is also bearish, which is an even better sign that this is a reversal. A Bullish Harami cross is a large down candle followed by a doji. It occurs during a downtrend. This predicts its reversal. In this picture, notice the downtrend, and at the bottom, this pattern occurs, the Bullish Harami cross. The market rarely gives a picture-perfect indicator, but you can see that the trend reverses at the bottom when these three candles appear. It starts with the last bearish candle, transitions over to the bullish cross, and the third candlestick pattern is the bullish uptrend. The Bearish Harami cross is a two-line bearish reversal pattern. The first candle engulfs the second one, being a doji candle, including the shadow. The Bearish Harami cross appears in an uptrend and predicts its reversal. Notice the candles test the line of resistance where the Harami cross occurred and continues a downtrend after. The testing of the candles back to the resistance line is important in knowing where to place stop loss and take profit once you enter a trade like this. We will cover this later in the book. The Tweezer's pattern is a minor trend reversal pattern that consists of two candlesticks with more or less the same high or a same low or some variation thereof. These are found at the top and bottom of trends, and they are two candlesticks that look very similar to one another in size. In this chart, you can identify two Tweezer patterns. The first is at the beginning, at the top of the bullish trend. After we see the Tweezers take place, we notice a strong bearish trend to the downside. Then in the middle of this chart, we see two nearly bottom tweezers with a slight uptick afterwards. The next candlestick pattern are the three white soldiers. In this case, they're green. These are a candlestick chart pattern in the financial markets that unfold across 3 trading sessions, and it suggests a strong price reversal from a bear market to a bull market. In this chart pattern, we see the 3 white soldiers, or the 3 green soldiers in this case, take place at the point of reversal. Just before we see the 3 white soldiers, notice the gravestone doji candle right before. The 3 black crows are the exact opposite of the 3 white soldiers. They unfold across 3 trading sessions and consist of 3 candlesticks that trend downward like a staircase. This usually results in a bearish reversal trend. Here you can see at the end of a bullish rally, the 3 black crows occur. Notice that there are many tests to this resistance line on the upside, but once we realize that the market will not break this price range, we see a very strong bearish trend, thus concluding the reversal. Here we will cover the engulfing patterns, which are very important because they often occur on the market. The bullish engulfing pattern is an important reversal pattern. It appears after a downtrend, and it's a 2 candlestick pattern. In this picture, a large green candle completely engulfs the preceding small red candle, and it results in a bullish trend after. In this chart, you can see 2 separate bullish engulfing patterns, both with the result of a bullish uptrend after. In the middle of this trend, we see the first one. It results in a high bullish rally. Then we have a period of consolidation that also results at the end with another bullish engulfing pattern. A bearish engulfing pattern is a 2 candlestick chart pattern that signals lower price movements. This is the exact opposite of the bullish engulfing. Here you can see the green candlestick followed by a large red candlestick that eclipses or engulfs the smaller bull candle. The result is a bearish trend. In this particular chart, you can notice at least 2 or 3 different bearish engulfing patterns. These occur at the top of the trends, and afterwards we see a strong pull down. Notice 1, 2, 3, and quite possibly 4 different bearish engulfing patterns on this chart and the results after. Alright guys, so this is going to be our break in between. It's a lot of information. Go over and review this again if you need to. Just take a breather, and if you guys need anything, of course, visit us at our free consultation page. And if you're ready to move forward, well, let's continue. In this section, we will cover double tops, double bottoms, and triple top and bottom patterns. First up is the double top. In this chart, you can see that there are 2 double top patterns. They occur at the peak of the trend. Once the double top has completed, we can see that there is a large retracement on both patterns. The double top is an extremely bearish technical reversal pattern that forms after an asset reaches a high price 2 consecutive times. When analyzing double top and double bottom patterns, we can use the same methods which apply to either the double top or the double bottom. In this case, when we're looking at a double bottom, we see 2 peaks. The first peak shows, and this is the level we're holding, and we get a reaction, and we see a reversal. The next peak is where the price returns, and more buyers are now willing to commit for a price reversal. Both triple tops and triple bottoms are great indicators for a change in the price of a trend of an instrument. whether it's a bullish or a bearish trend. These normally serve as an even stronger indicator than the double top and double bottom. Notice in this chart that the triple bottom reversal pattern is a great indicator of a price reversal. Not only does it test the line of support here, not once, not twice, but 3 times, this builds a consolidation period and sort of a buildup, and once it explodes, we see a price reversal to the upside. The head and shoulders pattern is a 3-segment pattern. First, you will notice the one shoulder, then a higher peak, which forms as a head, and then the third shoulder, which should be about the same length and size as the other shoulder. The head and shoulders pattern describes a specific formation that predicts a bullish to bearish trend reversal. In this chart, you can see the inverse head and shoulders, or the upside down head and shoulders. This serves exactly the same way as the head and shoulders pattern we just reviewed, whereas in this case, we see the head point to the very bottom of this downtrend, and the 2 shoulders, once formed, create the reversal into a bullish pattern. The rising wedge is a bearish pattern that begins wide at the bottom and contracts as prices move higher, and the trading range narrows. In contrast to symmetrical triangles, which have no definitive slope and no bullish or bearish bias, rising wedges definitely slope up and have a bearish bias. When traders notice rising wedge patterns, they look for good entry points to get into the downtrend or the bearish trend. With the falling wedge reversal pattern and the rising wedge pattern, you see these patterns quite often and other variations of them. Wedges, flags, and pennants are often seen in technical analysis. The falling wedge is a bullish pattern that begins wide at the top and contracts as prices move lower. You can also look at this as a correction on a trend. You can see from the picture, if you draw a straight line from the lowest lows and the highest highs, we see a triangle start to form because of the contraction. And once the candles break out the top of this straight line, we see the bullish run begin. Here we will talk about the cup and handle. These can be an upside down, which is the bearish, or the one you see in this picture, the cup and handle bullish. A cup and handle is considered a bullish continuation pattern and is used to identify buying opportunities. Notice that the cup takes a U shape and the handle has a slightly downward drift. The handle is a period of consolidation where there is selling pressure from investors who previously bought at those levels. This consolidation period can last from 4 days to 4 weeks before advancing higher. Always consider the length, the depth, and the volume of the cup and handle before entering a trade. Here we have the cup and handle bearish pattern. A profit target is determined by measuring the distance between the bottom of the cup and the pattern's breakout level, and extending that distance upward from the breakout. For example, if the distance between the bottom of the cup and the handle breakout level is 20 pips, a profit target is placed 20 pips above the pattern's handle. Stop loss orders may be placed either below the handle or below the cup depending on the trader's risk tolerance and market volatility. An ascending triangle is a pattern used in technical analysis that was created for price moves that allow for a horizontal line to be drawn along the swing highs and a rising trend line to be drawn along the swing lows. Oftentimes, traders are looking for big breakouts from triangle patterns. The ascending triangle is a bullish formation. It usually forms during an uptrend and usually continues. Here we have a descending triangle. A descending triangle is a bearish pattern that's used also in technical analysis, created by drawing one trend line that connects a series of lower highs in a descending order, and a second horizontal trend line that connects a series of lows. Oftentimes, traders watch for a move below the lower support trend line because it suggests that a downward momentum is building and a breakdown will occur soon. Once the breakdown occurs, traders enter into short positions and aggressively help push the price of the asset even lower. Symmetrical triangle patterns represent a buildup or consolidation period, and whenever these periods exist, normally the result is a breakout of price or a breakdown of price. Many traders use symmetrical triangles in conjunction with other forms of technical analysis that act as a confirmation. A rectangle pattern exhibits a period of consolidation where neither the bears nor the bulls take over that particular instrument. The pattern is easily identifiable by two comparable highs and two comparable lows. The highs and lows can be connected to form two parallel lines that make up the top and bottom of a rectangle. Bullish flag formations are found in instruments with strong uptrends. They are called bull flags because the pattern resembles a flag on a pole. The pole is the result of a vertical rise in an instrument, and the flag results from a period of consolidation. The best times to trade the bull flag pattern is just after the market breakout, during a strong trending market, or when it's near support and resistance. You can enter your trade with a buy stop order above the highs or wait for a close above the highs. A bear flag is a bearish chart pattern that signals the market is likely to head lower. It's the exact opposite of the bull flag. With a bear flag, you will see a strong momentum move lower with large range candles, meaning we have a strong downside movement. Then we have weak pullbacks with small range candles that form the bear flags. Here we would talk about bullish and bearish pennants. A pennant is a continuation pattern, and it's formed when there is a large price movement. Then there is a short period of consolidation, and then the continuation of the prior movement. The bullish flag is a variant of the bullish pennant, but the pennant is a period of consolidation that takes the form of a symmetrical triangle. Bearish pennants are continuation patterns as well. They mark a pause in the movement of a price, normally about halfway through a strong downtrend. This offers traders an opportunity to go short on their positions. They normally occur just after a sharp drop in price and resemble a triangular flag, as the price moves sideways or consolidates, making gradually lower highs and higher lows. Here we will take a look at the three rising valleys. Normally, the three rising valleys chart pattern will form after or at the end of a previous downward trend. As the name implies, we are looking for three valleys with each of the three lows being higher. To signal the end of a trend, we're looking for the market to start making higher highs and higher lows. This is where the three rising valley gives us this signal. The pattern confirms when price closes above the high of the second peak and after the third rising valley. This is the entry signal. There is a profit target that is the distance between the confirmation price, which is the highest high in the pattern, and the lowest low. We look at the three falling peaks as a bearish reversal trend. With the three peaks, all the peaks' high prices should be lower than the previous. The peaks should be fairly similar in width, and the suggested sell signal is triggered when prices close below the low price established by the valley between the second and third peaks. Basically, once you see the second and third peak, the valley in between those is a good place to start a sell or a short position once we see the candles break below that point. With the ascending and descending scallops, we want to look and think about the letter J. Scallops tend to be wider near the start of a price trend than near the end. A close above the highest high signals an upward breakout. Downward breakouts are a close below the pattern's low. A breakout confirms the scallop as a valid chart pattern. Keep in mind, when looking at an ascending scallop, sometimes they occur in a price trend multiple times. If they do this, they will get shorter and narrower as the trend end approaches. During this bullish run, you can notice the ascending scallop right in the middle of the trend. This confirms that as a continuation pattern, the bullish run is likely to continue. The descending scallop looks like the backward letter J. Find two peaks with a rounded valley in between and the left peak higher than the right one. This is the exact inverse of the ascending scallop. Ascending and descending scallops are arguably the most common chart patterns. In this pattern, you can see that we are in a strong bearish run. Right in the middle, we see the descending scallop appear and the continuation of this bearish run. Ideally, when the upside down J completes, any movement below that in this bearish pattern confirms the continuation and is a good entry point for traders. The measured move pattern is an old school chart pattern. It states that the market has the tendency to move in a similar price structure to how it moved recently. Not just the price distance should be the same, but also the time needed to reproduce the same move should be almost the same. You can see that on this chart we have a bullish trend. From one section's low to its high is around 1,215 pips approximately. Then we have a correction. The next low to the next high is approximately 1,224 pips, nearly identical movements. The measured move down is exactly the opposite of the measured move up. In this bearish move down, you can see three separate measured moves, all of equal distance. Notice that during this bearish move, we have slight upticks and corrections, and then the continuation down. Each high and each low for each measured move is 640 pips. This is a good indication that a trader can stay in the trade. If the bearish pattern continues, a trader should recognize the same measured moves. If the next bearish leg ends up being, say, 200 or 300 pips, this could be a sign of a weakening trend and a possible reversal. Also note that during this bearish trend, we see the bearish flag pattern. These are the periods where there is a slight correction and then the 640 pip movement afterwards to the downside. So if we tie in the bearish flag pattern with the measured move down, we have just created our first combination. Okay guys, this concludes the patterns section of our audio book. Keep in mind, if you need any assistance, you can reach out to us anytime you'd like. Hope you guys enjoyed it, and thank you for your time and listening to my voice. If you guys need any assistance, keep in mind tradesupportgroup.com, free consultation. We'll be more than happy to assist you guys and get you started with one of our professionals. Take care, guys, and look forward to the next chapter.